How's it going, everyone? My name's Jonathan Martis with North Pacific Real Estate. Today I have a special guest that I will be interviewing. It is Trevor Roberge from Capstone Home Loans. So the reason why I wanted to interview Trevor is because he has a lot of knowledge about loans. I help people buy and sell homes because I'm a real estate broker, but Trevor specializes in loans. So we're going to talk about assumable mortgages, rehab loans, zero down mortgages, down payment assistance programs. So we're going to talk about all these different options so that you can make a more informed decision when you're ready to buy. So let's get into it. Today I am interviewing Trevor Roberge from Capstone Home Loans. There's a lot of different loan programs out there right now with the interest rates being so high. A lot of buyers are kind of staying put. A lot of sellers are holding off because they're at this point where if they sell, they're like, well, the prices were so much higher before, so maybe I should wait for the interest rates to go down so then I can sell when they're higher. And then the buyers are holding off because obviously the interest rates are going up. They're paying more to borrow that money. But there's loan programs out there, and you're the expert on that.
Thanks for having me, by the way.
For sure.
Local lender here out of Linwood. Capstone Home Loans has been they've had a presence here for the last 10 plus years, and really excited that we're able to kind of weather through the storm. There's a lot of kind of crazy movement right now in our industry. A lot of mergers, a lot of acquisitions, but we've been able to build a nice community network here to kind of weather this storm. So. As a loan officer myself, I've been in the industry since 2004, and I, primarily work with first-time home buyers. That's kind of a niche that I've kind of carved out for myself. There's a lot of a lot of different loan programs out there, that help buyers get into houses a lot easier.
They don't even know about these programs that are out there that exist. They're most common would be FHA conventional, but there's other options out there. Yeah,
the standard assumption out there right now is I still need 20% down to buy a house.
Yeah.
And that's not the case at all. In fact, some programs we have, are true zero down. We're in a really interesting time in our market right now where the last 10 years we've seen historic low interest rates.
Yeah.
Rates have been, 2, 3, 4, 5%. And now with inflation, increasing over the last year, we've seen interest rates come up as well. Now with these high interest rates, obviously the mortgage payments go higher.
Yeah.
We have a lot of sellers, as you mentioned, sitting on the sidelines, hesitant to sell their houses because their mortgages are currently in the low 3-4% range.
Hard to get rid of that. So I'm in the same boat. I have a 3.125. I'm like, I would like to hold on to that.
Now, if you sell your house and you go out and buy another home, you're looking at interest rates in the 7, 8, 9% range.
Yeah.
So it's really difficult to justify selling your house and taking on a mortgage payment that could be a third to a 0.5% high, 50% higher than what you're currently paying.
Do you like searching for homes? Then you got to check out my website, northpacificrealestate.com. On this website, you can search for homes by community, by city, by zip code, by all these different criteria. And you can filter so many different options. There's large photos, and it's just a very nice website to use when searching for homes. You can even set up alerts so that you can get notified when new homes hit the market in the area you're searching for. So go ahead and check out my website. I will add it in the description below.
Now, the interesting thing about this market is that although interest rates are higher, as a buyer, you have the ability to come in and actually not have to compete with a dozen other buyers out there.
Yeah, that's true. Okay. It's not as competitive when the interest rate's higher and people are second guessing whether they should wait or...
Yes. So, over the last several years, buyers, especially first-time home buyers, have come into the market trying to buy a house, but they've had to compete against 6, 10, in some cases 15 or 20 other buyers for the same house.
Exactly. Yep.
So what happens when you have 12 different offers on a house? Everybody has to incrementally increase their offer to get their offer
to stand out. Yep. And I've been there. It's been crazy the last 2 to 3 years and how the market was changing. It was unbelievable to see what was happening.
Yeah.
Some homes, a home that I sold, we got $600,000 above list price, which was mind-boggling.
Wow.
Yeah.
Okay. So you're overpaying for a house, hoping that you're going to be able to recoup that in appreciation over the long run, right?
For sure.
Right now, we're not necessarily seeing multiple offers on every house.
Yeah, it's on very specific homes. It's very, in certain neighborhoods or a certain type of home, there will be, but definitely nowhere near as common as in the past, like 2020, 2021. That was way more common. 2022, we started to notice a shift like in April. After March, in my opinion, because I had listings during that time, it started to go down. The market, because of the interest rate changes, people started getting worried. But yeah, it's true.
So, as those rates have increased, now houses are tending to sit a little longer.
Yeah.
And now buyers can come in. It presents an opportunity to actually negotiate with the seller.
Yep, which didn't happen in the past, but it's good.
It didn't happen in the past.
Negotiation always helps.
Exactly. So not only can you potentially negotiate for the seller to help out with your closing costs, you may have an opportunity to actually offer less than what the seller is asking for.
Yeah, that is true.
A big takeaway that we're trying to communicate to every buyer is you can refinance a high interest rate. You can't refinance overpaying for a house.
Yeah.
Okay?
Because you still have that purchase price, which is going to be part of your loan amount.
Correct.
If you get a loan.
Correct. So, although rates are high right now, the most important thing a buyer can focus on is not necessarily the interest rate.
Yeah.
Focus on the payment. Are you comfortable with the payment that you're being offered with that specific loan program? And if so, it might be an opportunity to now get into the market, own a house, build equity over time, and then refinance down the road when rates do come down.
Yeah. All right, we're going to talk about down payment assistance. This is something that a lot of buyers aren't aware of. So can you tell us a little bit more about that, Trevor?
You bet. So in this market that we're in the greater Puget Sound area, home prices are steadily and slowly increasing over time.
Yeah.
It makes saving up for that down payment that much more difficult. Now, when you take a look at the standard loan program options that are available, what you're going to find is the majority do require some sort of down payment.
Yeah.
It's not 20% down.
You have to have some skin in the game, right?
You got to have some skin in the game, and it's not the 20% down that we're used to. It's 3 to 5% down typically. So a conventional loan, for instance, requires a minimum 3% down.
Yeah.
An FHA mortgage, Federal Housing Administration, they have a program that requires 3.5% down. We also have a VA home loan for the veterans. That's a true zero down program.
Yeah.
And then we have USDA loans as well.
You helped me with the loan, my wife and I, in the house we bought 5% down.
That's
so
right.
It exists.
That's right. That's right. Now the USDA loan is kind of an interesting one because it is true zero down as well, but you have to buy out in rural areas.
Yeah.
So it tends to be less utilized.
So the best way for that, would it be first for a buyer, if they're interested, to reach out to you to see if the property qualifies for that, or because there's certain requirements? Because if they were to reach out to me to help them, what would be the best way for them to approach it? Is it first for me to send you the property, or the requirements? How would that work best?
For the USDA loan?
Yeah, for the USDA.
So USDA, United States Department of Agriculture, the buyer's truly zero down. There's no down payment required by the buyer. If they find a home they like, that they're curious if USDA is going to work, they can go to the USDA's website and plug in the address. They can also, you can send it over to me. They can send me over the address, and I can research it as well. There's border lines that the USDA has created, and if that address falls within that USDA boundary, then that home is potentially eligible for USDA financing.
Would you say 95, 96% of houses don't qualify in our area?
It's a slim margin. Right? Yep. And then on top of that, USDA does have more restrictive guidelines on lending as well.
Yeah. Okay.
So if we're looking for the most flexible types of loan programs with no restrictions on boundary lines, the conventional mortgage and the FHA mortgage are going to be the most ideal.
Okay. Sounds great. And how does down payment assistance work with those loans?
Yeah. So if buyers are coming up short with saving up for that down payment of 3 to 3.5%, with these programs, we can utilize the down payment assistance programs to help cover that for them. So I have partnered with a nonprofit in Seattle called the Washington State Housing Finance Commission.
Okay.
And they have two really basic requirements to be eligible for the down payment assistance programs. The first requirement, you have to have a credit score of at least 580.
Okay, which I think most people have.
Most people do. And then there's also an income limit. You're not allowed to make over $180,000 a year.
Does that change yearly, or is it every few years in your experience?
Every year they have been increasing that income limit.
Okay.
So several years ago it was $97,000.
180s. So that's for the household?
Correct.
Okay, that's manageable. It's not super low to where almost no one would qualify.
Yeah.
It seems, so.
Now you can hypothetically, whoever's on the loan has to qualify below that 180 limit. So
Okay.
if the household makes $300,000,
Yeah.
you can technically still qualify if one of the individuals makes less than 180,000.
Oh, okay.
And they can qualify for
Good
that
to know.
house. Yeah. So ultimately we'll use one of these down payment assistance programs. There's a half a dozen that we can look at, and we'll pair the buyer up with either a conventional mortgage or an FHA mortgage.
Okay.
We can also use VA and USDA as well if they qualify for those two individual ones. And they'll get the down payment assistance to cover that 3 to 3.5% requirement they would normally need.
So the 3.5% and 5%, if that was the requirement of the loan, that means that they wouldn't have to come up with any cash?
Correct.
What about, so even for a 20%, typically most people think they need 20% down,
Yeah.
when a lot of programs can just be 5%. So that down payment assistance would help cover that, so they can get more
Exactly.
cash in their pocket.
Yeah, the Housing Commission will give you access to a loan up to 5%.
Okay.
So if you need
That's a
5%
lot.
down, you'll get a loan for 5%. Now the great thing about this is that the Housing Commission, that assistance that they give you comes in the form of a 0% interest rate mortgage. So you need to borrow $20,000. You'll get $20,000 to use for that down payment.
Yeah.
There's no interest being charged on that money.
Oh, that's good.
The only requirement is that you will have to pay it back at a later date.
Yeah, makes
Okay.
sense.
So that will occur when you either sell your house down the road, you just pay it back through the profit that you make in your sale.
Is there a time frame for that? To pay that back?
30
'Cause what
years.
if you sell your house? Oh, okay.
Yeah.
Because I was thinking, do you
Yep.
have to pay it back within a certain time frame? Because what if you don't sell for 9 years?
There's 4 triggers. So you either sell your house down the road, you just pay it back through the profit that you make in the sale, or if you refinance your first mortgage into a lower interest rate,
Yeah.
you can consolidate both the first loan and the assistance into one brand new mortgage.
Oh, okay.
Now, of course, you have to have equity in your house to consolidate
Yeah.
the two. The third option, 30 years from now, you've paid off your house in full, you'd have to pay back the assistance then. And then the fourth is if you decide to depart your residence, turn that property into a rental property.
Yeah.
When you vacate that property, they want you to pay that
Because it's not going to be the
assistance back.
primary residence. It has to be your primary residence, correct?
Correct, yeah.
Okay. Yeah, that makes sense. That's awesome. I mean, being able to even let some of my clients know about this is great, because I was just talking to a friend of mine from church, about buying a house, and he's talking about the down payment. And that's one of the first things people think about, because they may make pretty good money in their job, right? And they can cover the payment for the house.
Right.
But the down payment is a little harder because it's a big chunk because of where we live. Houses are a little more expensive. So, if it's 20% and that's what they have in their mind of what they have to pay, it's a lot of money.
Yeah.
So that 5% that's big. It's huge.
Not only do they get to keep the money they have, in their bank account, but now when you move, there's some unforeseen expenses you might run into, right?
Yeah.
You have your moving expenses. It's not
all
cheap
add
to
up.
move right now. You also have some small updates or fixes that you want to do on your house after you move in. That's going to be expensive.
Yep.
Furnishing your house.
Yeah.
Right? You got 5 new rooms that you have to put furniture in.
Yep.
Furniture is not cheap. So, and then also ultimately at the end of the day, you want to make sure you have a couple months of your mortgage payment set aside.
Yeah.
As you transition to your new house, it's always good peace of mind knowing that you have your, a couple months of your mortgage payment. So this is a great tool to utilize something else for your down payment, a 0% interest rate loan, and then keep the money you have in your bank account for all those other things.
Yeah, that makes sense. So if somebody's wanting to learn a little bit more, let me say it this way. If someone's buying a house, the 5% is being covered with the down payment assistance. What do they need to pay for fees? What are common fees associated once they close on the house? Because the down payment's one portion of it,
Right.
as we know when we see settlement statements. What other fees would they be responsible for at the closing table?
Great question.
Really quick, I noticed a lot of you are not subscribed to my YouTube channel. If you could please hit that subscribe button, I'd greatly appreciate that. And also if you hit that like button, it'll help get this video out to more people. Thank you so much, and back to the video.
There are going to be closing costs associated with buying a house.
Yeah,
Okay. There's
there always is, yeah.
generally 2 categories. You have your third-party fees.
Yeah.
So there's a handful of different third parties that help you get into your house.
Yeah.
They all charge a fee. You
course,
have an
yep.
underwriter who underwrites your file. You have a processing team that processes all your
And
paperwork.
this is with all loans.
All loans, you're gonna run into this. There's an appraiser that goes out to the house.
Yep.
They're going to appraise the home. They generally charge a fee. You're going to have title insurance that's required. An escrow officer is going to be managing all the money for everybody. So all of those fees, I'm going to throw out a ballpark number. You're probably looking anywhere between like $4,000 and $7,000.
Yeah.
Okay. You also have your prepaid items. These are your property taxes. You need to prepay for 6 months up front. You have homeowners insurance you have to prepay for a full year, and then a couple extra reserve months as well. You have recording fees, you have your prepaid interest that you pay on your mortgage. As soon as you own your house, you have to start paying interest.
Yeah, and these are things that would be there anyway.
Correct.
So the down payment assistance just allows these buyers to have extra money that they wouldn't have had it because it goes towards the down payment, and they can use that for other things.
Correct.
Which everybody appreciates, because I know when I bought homes in the past, it just seems like you see the money's going down. You're like, I bought a house, I'm excited, but it'd be nice to have a little extra. So this is helpful for many buyers. And that's why I wanted to make this video and interview you, is because a lot of people aren't aware of the programs that are out there.
Right.
And so the more informed they are, then they can make a better decision when they do want to purchase a home. So.
Yep. Now there is one other down payment assistance program that I wanted to bring light to because it's very underutilized. It's our Home Choice program. So
and really quick before you get into that, we have to mention that you are number 3 related to this program in the state.
Correct.
I want people to know that you have experience with this.
Yeah, so the Washington State Housing Commission, they have a list of 10 premier lenders.
Yeah.
I'm listed 3rd on their website.
Congrats.
So thank
awesome.
you. Thank you. I help a lot of first-time home buyers, and it's an honor, and a blessing to help, as many as we do.
That's awesome.
Yeah, so there's one additional down payment assistance program that I wanted to bring to light because it's very underutilized.
Okay.
It's the Home Choice program. It's geared for families that have a disability. So a family member that has a disability within the family, they get access to a special program with an incredibly low interest rate and also assistance up to $15,000.
Nice.
So.
And is there, where can people find out more information about how they would qualify for that? Is there maybe a website? Should they reach out to you?
Yeah, reach out to me.
Way?
Yeah, I mean, really the basic concept with this program, the requirement is someone, in the family has to have a disability that's within the ADA's definition.
Okay,
So
perfect.
the Americans with Disabilities Act of 1990 came out with the definition, and there's a list of specific requirements that the buyers have to, or that the family member has to fall within in order to qualify.
Yeah.
Ultimately, it's, a letter from their doctor confirming that they have a disability.
Okay, and it was up to $15,000 with down payment assistance?
That's correct.
Perfect, great.
Yep.
I want to talk about rehab loans.
Yes.
I was talking to someone at a birthday party last week, and we were talking about rehab loans. And I've helped someone in the past with a rehab loan. There's certain requirements. There's some confusion related to just how it works. Some of the viewers may be curious, like, if I want to take some money with the loan and renovate the property, maybe that's something you'd like to do. I wanted to talk to Trevor about it so that they can understand how that process works. And for many, they're not even aware that they can actually remodel a home with money from the loan so that they don't have to put all the money towards the down payment, then try to get other cash to renovate. Right. So if you can talk about that a little bit.
So the FHA has a 203K rehab loan. It's the standard rehab loan that we utilize. The conventional mortgages have also come out with a rehab loan.
Oh, interesting.
Fannie Mae and Freddie Mac both have their rehab loans as well. Those do require 3 to 5% down depending on the qualifications. With FHA, it's really only 3.5% down. So that's the great, the convenience of this type of program is rather than having to pull another $50,000 out of your bank account to rehab the house after you've moved into it, you can finance all the rehab costs into the mortgage itself.
Yeah.
So
that's huge.
So, for instance, you find a house that either can't get financed because it needs tons of work and the lender isn't willing to approve a type of property like this, or you have a property that you have a big vision for, and you want an affordable way to rehab the house. You can use a rehab loan for that.
Yeah, and that's the thing is some homes that I've showed clients before is there's a hole in the roof, there's different things that wouldn't qualify for a typical loan. And so a rehab loan might be a good option for that.
Correct. Most of the time a seller doesn't have the extra cash on the sidelines when they sell their house to, do the really big major fixes. You'll also find this with short sales. A house is being sold as a short sale or a foreclosed property.
Yeah.
One that has significant deferred maintenance, the seller's moved out, now the lender is selling the property. A rehab loan is a great opportunity to actually come in and purchase the house.
So what would that process look like if you can lead us through the steps? I'm helping a buyer find a property. What would help it qualify for a rehab loan, and what steps would they need to go through to get from from A to Z? How does that process look like, if you can quickly overview it?
Sure, you bet. The mortgage process is pretty similar to what you'd find with a normal, home purchase.
Yeah.
The only the differences are going to be the involvement that the buyer needs to have with contractors up front.
Because they have to get some bids, right? They have to have a way
Correct.
to show, okay, this is what it might cost, and so there's a process to
You
that.
got to have a full scope of work laid out by the contractors. Ideally, you want one general contractor that can handle the whole project rather than having multiple bids.
It just has to be licensed, bonded, insured contractor.
Exactly.
And then they need to give, obviously, different quotes and with details that will show what needs to be taken care of.
Correct.
Which is not a big deal. I mean, there's plenty of contractors that can do that. And for what they get, to have a house that can be renovated with part of that loan covering the costs, I think
Right.
it's worth it. And my friend that used that loan, I mean, his place looks amazing.
Yeah.
And if it wasn't for that program, it would have been much harder to
Correct.
have that place renovated.
Yeah. So once you have all of your bids in place, and obviously the underwriter signs off on everything, there may be an inspector that's involved as well to make
Yeah.
sure that everything is within the normal mortgage guidelines
sure,
to make
yeah.
sure everything's been done properly.
Makes sense.
The transaction closes. The contractor will come out after closing. They have generally a window of up to 6 months to get all the rehab done.
Okay, so that's the maximum time that they will have to be able to do renovations.
Correct.
Which I think for most homes should be enough.
Hopefully.
Yeah, because they're not building a new house, right? They're just
Right.
doing some renovations inside.
Correct.
Maybe it could be new flooring, it can be kitchen renovation, but
Yeah.
maybe the roof.
Yep.
Are there any things that can be done with that loan?
The majority of the work is, the standard interior, exterior. There are a few things that you can't do. They don't want you to install a pool.
Yeah, something it's not a necessity.
Exactly. Yeah. I think landscaping is probably, part of the acceptable allowance.
Yeah,
But they just don't want the extravagant stuff.
of course.
Right?
Yeah, makes sense.
You have to stay within the same footprint as well, so you can't redesign. You can't take a house and completely demolish it and then redesign, a brand new footprint.
Yeah,
Foundation.
makes sense, yeah.
So everything has to stay within the standard footprint.
We want to talk next about assumable mortgages. You probably heard about this on the news, where you take over someone's loan and you can actually get their interest rate, and maybe that was something in the high twos, which would be amazing. Let's talk to Trevor and let's learn more, Trevor, about how that works. So buyers and just people that watch the channel can learn more about the process, because a lot of times you'll see the news articles and, oh, that sounds great, but there's more details.
There's a big catch there.
Yeah.
Yeah.
How do those work?
Yeah, so let's say a seller, they purchased their house or they refinanced 3 or 4 years ago down to a low 2.5% interest rate.
Yeah.
The assumption comes in with a very specific type of loan program. So the FHA loan, it's an assumable loan. The VA loan, it's an assumable loan. Conventional generally isn't going to be assumable.
Okay.
So the assumption is a feature that's added onto the mortgage. So if a seller decides that they want to sell their house, they have the right to allow a new buyer to come in and assume that mortgage. Now the big catch is,
Yeah, that's what we want to know.
big catch here. Okay, so let's say the buyer's like, I want to take advantage of that 2.75% interest rate you have, Mr. Seller. How do I do that? Well, the buyer has to go to the original servicer of that mortgage, and they have to apply with that lender.
Okay.
Okay, so there's a servicer that may or may not grant you the ability to assume that mortgage. So there are some restrictions. I had a client who reached out. And
Is it because they changed the way that they no longer do that, or what would determine whether they would want to or not?
Yeah, I would assume the servicer, although it may be an assumable loan, maybe they have certain restrictions. I mean, every servicer is probably going to be a little different.
Yeah.
So, the seller should take a proactive approach and reach out to their mortgage servicer and ask, hey, is my loan assumable? And if it is, what are the requirements?
They'll look into it. It's not an automatic yes or no. Okay.
Yeah. And some listing agents will actually list, hey, this property has a mortgage with a 2.75 assumable loan. But is it really assumable? Like, we got to dig a little deeper and see what the restrictions are.
Maybe better
with that
it would say could be. It's possible it could be assumable.
Possibly.
Not a guarantee. Yeah.
Now, the other big catch is Let's say the seller has a mortgage of $200,000 on his house, but he wants to sell the house for $400,000. Okay? Well, if the buyer wants to come in and assume that $200,000 mortgage, that's all they're going to get. It's a mortgage of $200,000. Right? So there's a $200,000 difference there that the buyer has to potentially come out of pocket with to meet what the seller wants to list their house for.
Would they be able to get a second loan for that difference?
That's when it gets really complicated.
Because that's one of the questions I was wondering.
Right.
I was thinking about this. There's a difference in the purchase price on what you're buying it for and then what their loan is at. Maybe they have a lower loan amount. So how does that work?
I don't necessarily...
Not everyone's going to have all that extra cash.
I don't necessarily know that answer, but I would assume it's going to be really difficult to go out and find a second mortgage to be placed behind a mortgage that's already in place. And if that mortgage is a government loan, like an FHA loan or a VA loan, the servicer may say, I don't want to take on the risk of having a second mortgage behind us. Or the second lender may say, we don't want to be in second position.
They want to be first in line
behind the first.
The lien list, right?
So that's a lot of research that the buyers are potentially going to have to take on. Unfortunately, me as a loan officer, I can't help them. Because they're going to have to go directly to the original servicer of that,
I see.
Of that
so
mortgage.
they have to go to the original loan provider.
Correct.
And the best way in my mind, correct me if I'm wrong, if someone wants to take advantage of this, it would almost be where, assuming that the loan provider would allow this, someone who bought a home, let's say a couple years ago, got a really low interest rate, there's still a pretty high balance, and the purchase price is close to what the loan amount is. That probably would be the best scenario, but that's not going to be very common in my opinion. It seems people like that low interest rate, and because the interest rates are higher now, they may want to hold on to it. But that's where it seems like it'd be the best option is if the loan amount was closer to the purchase price, unless you have all this extra cash that you're going to put towards that house and make up the difference.
The assumption is a benefit for, I guess, both parties when the seller isn't going to make a whole lot of money or the buyer has enough to cover whatever the difference is, right? I mean, don't get me wrong, I would love a 2.75% interest rate, but do I have an extra 20, 30, 40% down payment to meet what the seller wants to sell their house for?
Exactly, that's the hard part.
Okay. So it's one of those case-by-case scenarios, and if you can put it all together and make it work, good on you for taking advantage of that opportunity.
Everybody would like to know where interest rates are heading. So I want to ask Trevor, being an expert in the field, where do you think interest rates are heading?
If I knew that answer, I'd be a millionaire. Ultimately, the trend is your friend. That's usually what the saying is in the stock market, and we can kind of apply that to rates as well. Rates have been going up.
They've
been going up for the last year and a half. Are they going to continue going? Maybe. I mean, I don't think we've hit really a top ceiling yet. The sentiment in the market is rates are going to be higher for longer. So ideally, we'd love to see core inflation come down. That's the gauge that the Fed is taken to really decide if they're going to continue raising their Fed rate or not. And they're still unsure. So until the Fed starts retreating their Fed rate, we're probably going to see rates stay in this market. Now,
hovering around 8.
8. I hope it doesn't go any higher than 8.
I heard some people were saying it might go to 9. I'm like, oh man.
There was an old coin phrase that we used to use back in the day. Rates below 8 are great. And now we've actually hit 8%, which I would never anticipated
have to
seeing
find
that.
a different way to make that rhyme.
Right. Rates below 18 are great. The bottom line here in this market, we're in a really, the Puget Sound is in a really insulated market. We have some incredible tech. We have incredible companies that have grown their businesses here.
Still a ton of demand. People moving. A lot of
Tons
people from
of
California.
Demand here. Yep. A lot of people coming into Washington.
Most popular states for that, for when they're moving out into some other state. So it's still growing, limited amount of space where you can build homes. It's not like it's just flat everywhere.
Correct.
I have a brother in California. He just buys a lot of land and puts a house. I'm like, it's not like that here.
No.
We can't just go find some land. It's very difficult to find.
So if you can find a house and get yourself into some real estate, start building that equity. Over the long run, real estate has an incredible track record.
For sure.
Right? So, that's what we're really driving home is, mortgages, those mortgage payments don't increase over time like rent does. We're continuing to see rents increase every year. And if you can lock yourself into a specific interest rate, and then look obviously for an opportunity to refinance when rates do come down.
Yeah, because eventually, I mean, if you wait too long, who knows how long you're going to be waiting. It's more about finding the right property and seeing if you have some more down payment to lower that mortgage monthly payment, or take advantage of maybe the down payment assistance. So I think those are all good options and things for people to consider. So Trevor, wanted to thank you for this time for us just to talk more about the real estate market. You're the expert in this field. I know about real estate, helping people buy and sell, right? But I'm not an expert on loans. That's why I wanted to interview Trevor. So Trevor Roberge with Capstone Home Loans. I'll put his information in the description below, so you can feel free to reach out to him. Drop a comment below if you have any questions. So, Trevor can jump on here on the channel and answer some of your questions if that's more comfortable for you. And just let me know what you think about this content. Is this something that's interesting to you? Appreciate you tuning in, and I'll see you on the next video. Now, let's be honest. That information was helpful, right? I hope you're able to learn more about different loan programs. Reach out to Trevor or myself if you are interested in purchasing a house and want to learn more about these programs, and then we will help you out from there. If you have not subscribed to the channel yet, please hit that subscribe button, because I do plan on having more people on these different podcast shows that I will be putting together. Appreciate you tuning in, and I'll see you on the next one.